So again, we just show that this is the disclaimer that we have. Again, my name is Andrew Latimer, and Christine Gonzalez will be here presenting with me. Very knowledgeable, so hopefully we'll give you some good information. And to start off just with our agenda, just so you know, the reason we thought we'd do this is we're now 1 year in on the Tax Jobs Act, and there are lots of things that we could take advantage of that we now know the rules. We've seen some intricacies. We'll talk a little bit about some of the things we saw. So we'll bring you up to date on the Tax Cuts and Jobs Act and talk about some new provisions that there are out there for federal and state purposes that are outside the Tax Cuts and Jobs Act. And so our agenda is we'll talk about some individual taxes, we'll talk about some business taxes, and we'll end with some state and local taxes with the Northeast flavor here with Massachusetts, Rhode Island, and Connecticut.
Good morning, and thank you for joining us. I'm going to start with individual taxes. We're going to talk about strategy, we're going to talk about some tax planning tips, and an overall refresher on some of the changes in the 2017 Tax Cuts and Jobs Act. Beginning in 2018 through 2025, we have new income tax rates and brackets for individuals, estates, and trusts. Those new tax rates range from 10% to 37%. Prior to the change, our highest tax rate was 39.6%. Standard deduction nearly doubled between 2017 and 2018 and was increased again in 2019. The standard deduction for 2019 for married filing joint taxpayers is $24,400. With this significant increase in the standard deduction and limitations in itemized deductions, what I found this past tax filing season for 2018 is many more taxpayers utilizing the standard deduction as opposed to itemizing. As we go through, I'll give you some tips on how we can start to increase some of our itemized deductions. Personal exemptions were suspended. These are the deductions you get for yourself, your spouse, and your dependents. Higher AMT exemption amounts were put into place. We were actually hoping the AMT tax would be repealed for individuals. That was not the case. But again, this past tax filing season, we saw a significant number of taxpayers who were previously in AMT no longer subject to AMT. So it definitely was a significant benefit. Child tax credit and phase-out levels were increased. Again, we saw an uptick in the number of taxpayers who actually benefited from the child tax credit. So standard deduction versus itemized deduction. Probably the biggest change in itemized deductions with the Tax Cuts and Jobs Act and the most publicized is the new limitation on state and local tax deduction. We're limited to $10,000 now. That includes state income taxes, property taxes, real estate taxes. All in, you're at $10,000 limit.
And Christine, I think you would agree that part of the reason that we didn't see a lot of people into the alternative minimum tax is because real estate taxes and state and local taxes that were drivers of putting people in real estate taxes in alternative minimum tax. Now with the lower deduction limit is another reason we didn't see a lot of people in AMT.
Absolutely, great point. So one of the strategies that people used to implement at year end is prepaying your state taxes. Due to the $10,000 limit, in most cases, that's no longer going to be beneficial. High tax states responded to the change in state and local taxes by implementing some workarounds. Connecticut actually pioneered this change through implementation of a pass-through entity tax. It's called the Connecticut PET. This effectively shifts the burden from the individual to the entity for paying state taxes. By creating an entity tax, the business actually gets a deduction for the state tax, taxes where the individual would not. In addition, a credit flows out to the partner or shareholder on their K-1, and they would use this credit to offset their personal Connecticut income taxes. Besides Connecticut, other states have created elective versions of the PET, and we have many other states considering some type of PET legislation. IRS has not yet ruled on the federal deductibility of the PET tax, but they obviously were not happy when they got wind of this. They have a priority list for 2019-2020, and tackling this PET tax deduction is actually on their list. So whether or not we continue to get the deduction at the business level is to be determined. Keep in mind, too, that states like California and New York and some others allow itemized deductions on the state tax return, and they have decoupled from the state and local deduction limitation of $10,000. So you're still going to want to keep track of the full amount of your income taxes, real estate taxes, property taxes, because you could end up with a benefit at the state level, even if you don't have the full benefit at the federal level. Mortgage interest deduction was also limited. You're limited to $750,000 of acquisition indebtedness. Acquisition indebtedness is the amount to purchase, construct, improve, or reconstruct property. The deduction for home equity indebtedness was suspended. Now, there was some confusion over this. You do have to trace the funds from your home equity line, what they were used for. If they were used for acquisition indebtedness, that interest would still count towards the $750,000 acquisition indebtedness limit. You also want to look for potential business use of those funds, potential investment use of those funds, because you still could get a benefit as a business interest deduction or an investment interest deduction. There was a grandfather clause, so if you had acquisition indebtedness incurred prior to December 15, 2017, your limit is still the $1 million. A tip on the mortgage interest deduction, you could consider paying down or off your mortgage or home equity lines, especially if you're taking the standard deduction going forward. Charitable contributions. Previously, charitable contributions were limited to 50% of adjusted gross income. That limitation has increased to 60% of adjusted gross income. Now, keep in mind, you don't get a tax benefit until your standard deduction is exceeded. And now that the state and local tax deduction is limited to $10,000, there are many more situations where you're using the standard deduction as opposed to itemizing. Some tips on how to get your charitable deductions increased and incur a benefit for them. One hot topic that we've seen is donor advised funds. What happens in a donor advised funds is you make a contribution to your donor advised fund, you get a deduction for the full amount of the contribution in the year you made it. The funds are then distributed from the donor advised fund to the charities. It could be later that year, it could be in a subsequent year. You wouldn't get a deduction for the charity when it's distributed to the charity. But you are getting an upfront deduction, which could increase the amount of charitable you're getting in the given year. Another strategy is bunching contributions. Consider bunching your contributions into several years into 1 year, or even on alternating years. An example of that, if you're contributing $10,000 a year, let's say, for 2019 and 2020, and in that year, your only other itemized deduction is your limited $10,000 state and local tax. You have $20,000 itemized deductions in 2019, $20,000 in 2020. So in both years, you're going to end up taking the standard deduction. But if the two tens were contributed in 1 year, whether it's 2019 or 2020, now you have a $20,000 charitable contribution plus the $10,000 state and local tax, you're at $30,000. That exceeds the standard deduction by almost $6,000. So you're giving yourself a $6,000 extra deduction that you would not have had if you contributed $10,000 in each of the 2 years. Qualified charitable distribution is another added benefit. You have to be 70 and a half or older to participate. You can contribute up to $100,000 of your required minimum distribution directly to charity. The benefit is 100% reduction of AGI for that amount that was contributed to charity. Again, you don't get a deduction you don't get a charitable deduction, but you're taking that RMD out of your income. That could help you with your tax brackets, and it's a significant benefit if you're taking the standard deduction because you wouldn't have gotten any benefit for your charity anyway.
Right, and I think some of the other things, Christine, are in Connecticut, because they go off adjusted gross income. They don't that IRA distribution wouldn't be taxable there. And then by reducing the adjusted gross income, we're going to talk about this later, but there's other reasons why if you reduce your adjusted gross income, it might help you either get a child tax credit, it might help you with the 199A deduction, all sorts of things. So it's important. It might be a good use of the $100,000 if you need to.
Exactly. Another strategy is donating appreciated capital gain property to charity. You're avoiding the capital gain tax on the appreciation of the stock, and you're getting a deduction for the fair market value of the stock as opposed to the cost basis. Generally, this is limited to 30% of your AGI, depending on what you're contributing and to who. Miscellaneous itemized deductions were suspended. So investment expenses, professional fees, no longer deductible for federal tax purposes. Keep in mind, as I mentioned earlier, some states that allow itemized deductions you might still get a benefit in those states. Unreimbursed employee business expenses is a big one. One tip for that is to consider an accountable plan. This would happen at the employer level, but the theory is the employer would pay the expense in the form of a non-taxable benefit. Generally, they would reduce the employee's income by the same amount. So the employer's in the same place. Instead of paying, let's say, $1,000 of employee W-2, they're paying $1,000 of the employee's business expenses. So they're whole. From an employee standpoint, though, let's say the employee would have received a salary of $5,000 and had a $1,000 employee business expense. They would have had $5,000 of taxable income. They would have paid $1,000 of that to cover their expenses and not get a deduction for it. In this case, their $5,000 was reduced to $4,000 of taxable income, so their cash flow is in the same place, but they converted taxable compensation to a non-taxable benefit. An added benefit for both parties is a reduction in FICA taxes. If you're considering this plan, there are specific rules as far as what types of expenses qualify, the timing, the paperwork, documentation. So you're going to want to make sure your I's are dotted and your T's are crossed so that you have a truly eligible plan. Personal casualty and theft losses were suspended except for losses incurred in a federally declared disaster area.
Great, thanks, Christine. So I'm going to talk a little bit about some other modifications. Prior to 12/31/2018, in any divorce agreement, the alimony paid would actually be a deduction, and the alimony received would actually be taxable to the recipient. So after 12/31/2018, any new divorce agreement that you come into, the alimony is now not a deduction for the person paying it, and the person receiving it actually doesn't have to pick it up into income. So that's something that's new for 2019. Any agreement that was placed in service before that will not be modified, but anything that goes on after January 1st, 2019 would need to take this into account. The next thing I was going to talk about is moving expenses, and those moving expenses used to be deductible, but with the new Tax Cuts and Jobs Act, they're now not deductible. Those expenses have been suspended. So if you were to move from, Chicago to Sacramento, California, those moving expenses might have been deductible in the past, but they are no longer deductible at the federal level. The other modification we wanted to talk about was the kiddie tax. Again, what you used to do is you'd have to wait to file the parent's return, and you'd have to use their tax rate in order to figure out the tax on unearned income for the child, anyone under 24 years old that had significant unearned income, such as interest and dividends. But starting with the new act, the kiddie tax is now based on trust rates, where the top rate starts at $12,500, versus $600,000 for a married filing jointly. So one of the things to think about is you may want to figure out if you want to make an election to include the kiddie tax or your child's tax on your individual return as a married filing jointly, because they might be at a lower level. Certain circumstances you should definitely look at.
And you can include them on your personal return if they have their unearned income is limited to interest and dividends. Congress did indicate that there was an intention to correct this change in the kiddie tax, but no action has yet been taken because they realize it is a detriment for certain situations, given that the highest tax rate for trusts, you get there so much quicker than you do instead of an individual return.
Right. Yeah, and I saw that they're actually thinking about going back to the way it used to be. So more information to come, but something to look out for. The next is the ACA mandate. They repealed the individual mandate penalty, so it's no longer in effect. So if you don't have health care, in the past there was a penalty because you didn't have health care. That penalty is now zero. So the penalty is still out there. It's just instead of being $695, it's actually going to be zero. And then another thing we want to talk about, and I think this is important given where we may be in a couple years, but for estate and gift tax exclusions, the annual exclusion right now is $15,000 a person, and the lifetime exemption is $11.4 million. And unknowing where this exclusion and exemption may go in the next couple years, depending on who lands in office, whether it continues to be Trump or goes over to a Democrat and where the House sits, a lot of people should take advantage of that now because they know where it is, and they have talked about how there's going to be no clawback. So if you gave away $11 million this year for your lifetime exemption, and they brought the exemption back down to like $3.5 or $5 million, they wouldn't all of a sudden say, "Oh, we're gonna claw back and get you on that." So people should take advantage of the exclusions while they're still out there. So with so many independent contractors, starting up their new businesses, giving new tax laws, I thought it was important to talk about some of the different retirement plan options for independent contractors. As those of us that are employees, we know we have our 401k plans, but for independent contractors, there's several different alternatives that they can look at. So the first one I want to talk about is a simple IRA. And essentially, you're able to put away $12,500 a year into a simple IRA, and it's $15,500 if you're over 50. So it's a nice plan. You can put away a little bit more than a traditional Roth IRA or a traditional IRA of $5,500 to $6,500. But so this is a good way to put away a little bit more money. It's a little bit more complicated because if you have employees, you're required to do two things. The first is you need to match each employee's salary deferral contribution on a dollar-for-dollar basis up to 3% of his or her salary. Or you can make a non-elective contribution of 2% of each employee's salary to each employee's plan, whether that person chooses to contribute to the plan or not. So again, great plan out there, but if you do have some employees, it's something to look about. The next retirement plan is a SEP IRA. And a SEP IRA is got a very good advantage because it's a very high contribution limit. So you can pay 25% of your pay up to $53,000 a year. So again, you're putting away more than a simple IRA. You're putting more away than a traditional or a Roth IRA. So it really helps you with your retirement savings. The disadvantage is if that you have employees, you'll need to contribute the same percentage for them as you. So if you contribute 25% of your salary, you'll have to contribute 25% of their salary too. In 2019, one of the hottest retirement planning options I've seen has been the solo 401k. And it's exactly what what you think it is. It's a one person only 401k. So very popular with some tax consulting people or just people that are consulting in general. And so what can happen here is you can put away $18,000 right off the bat, $24,000 if you're over 50 of your earnings into the plan. And then on top of that, you can put an additional 25% of your salary up to the $53,000 or $59,000 for over 50. And the big advantage here is that you're able to put that 18 or the 24 up front. And so you can do that even if your salary doesn't have the 25% in there. And then the other advantage is you're actually able to borrow from it. So it works just like if you borrowed from your 401k at work. The disadvantage is that there is an administrative hassle. If your plan gets too big, you've got to report it to the IRS, do some more administrative paperwork. So although you're able to put away a lot more money, there is an administrative hassle. And then finally, the retirement plan that we've all probably learned to know and love is the traditional and Roth IRAs, where you could put away $5,500 or $6,500 if you're over 50. So those are some of the different retirement plans that we have out there, and I think that they're good options for people to take advantage of. And if you have any questions, we'll be happy to answer about it. The retirement plans probably could be a subject or webinar on itself.
On the, just a note on the retirement plans, many of them you still have until year end to set up a plan, and then generally you have until the filing deadline of your tax return to make a contribution. So I know the year appears to be quickly coming to a close, but you still have time to set one up if you haven't already.
Yeah, good point. I know, especially with the solo 401ks, I've seen actually quite a few people setting those up lately to get them done by 12/31. But their plan is to actually fund it by the time they file their tax return. So good point.
So we'll move on to business taxes. Corporate tax rates were reduced to a flat 21% tax rate. One unintended consequence that we've seen is this actually turned out to be an increase in tax for some small corporations. If you remember, prior to the flat tax, we had an incremental tax. So the first $50,000 of income was taxed at 15%. Now that we have a flat 21%, anyone who would have had taxable income up to $50,000 actually has an increase in tax rate of about 6%. C Corp versus S Corp. When these tax rates for corporations were changed to 21%, down from the prior max of 35%, we had a lot of questions coming in about converting S Corps to C Corps or starting up companies as a C Corp. It's important to note that modeling needs to be done before we make any type of decision like this. We have, here at the firm, we have a tax advisory group. We rely on them to do a lot of modeling because there are many factors that you need to take into consideration. Your exit strategy, the timing of your exit strategy, your distribution patterns, personal tax rates, the fact that S Corps and other pass-through entities now have the ability to have a 199A qualified business tax deduction, which we'll talk about later on. I mean, all of these factors need to be taken into consideration, and not only for the year in question, but for 5 years out, for 10 years out, you want to make sure this is the right decision for you. We have done some modeling in this area, and I think for the most part, we found that remaining a pass-through entity is still probably the most favorable. Obviously, there's not one size fits all, but we can definitely look into that if there's any questions. Section 1202 stock has been around for a while, but it's started to gain more popularity now that with the other changes in the tax code. Section 1202 stock is qualified small business stock. The benefit here is that certain corporations can be eligible to have all or part of the gain on the ultimate sale of their stock be excluded from tax if some specific requirements are met. Those requirements include being an active trader business, It has to be original issuance stock and held for 5 years. There has to be significant tax basis. That means there has to be an upfront investment in the corporation, and then you're limited to how much in earnings you can take back out of the company or distributions. So again, it's a complex area. It could be a significant tax benefit. You're also hedging on the fact that this corporation is going to appreciate in value. So we can do some modeling on that. Again, not one size fits all, but there are some unique situations that this might actually save a lot of money. Corporate AMT was repealed. We were hoping for individual and corporate AMT being repealed, but it was only for corporations for this year. Accounting method simplification. There are rules as to which types of businesses can use a cash basis and which can use an accrual basis. In the past, there was a gross receipts test, which was limited to $5 million. So if the average of your last 3 years of gross receipts was $5 million or less, and you were required to be on the accrual basis, you were allowed to use the cash basis instead. That $5 million threshold was increased to $25 million in the Tax Cuts and Jobs Act, and it's been indexed for inflation in 2019 to $26 million. So now if your gross receipts test shows that your average 3-year gross receipts is $26 million or less, you can use a cash basis even if you meet the requirements to be an accrual basis taxpayer. So that puts far more people into the category of that added benefit. The same $26 million threshold applies for UNICAP, which is the capitalization of inventory. If you're the $26 million and under of gross receipts, you're exempt from having to do that calculation and make that adjustment. And same applies for percentage of completion, which is most popular with construction contractors. You can instead use completed contract or accrual or any other approved method. So if you are if you do now benefit from using cash basis and being exempt from UNICAP and percentage of completion, you'd have to make an accounting change on Form 3115. It's an automatic change, meaning the IRS consent is not required, but you do have to do your true-up calculations and file the form with your tax return.
All right, so now we're going to talk about some major overhauls. This is a lot of things that were wildly either popular or unpopular, depending on the item. And I think each one of these, we probably could go on for half an hour. But just wanted to talk a little bit first about the 199A qualified business income deduction. And that is for flow-through entities. And as Christine talked about, the tax rate for individuals, the highest tax rate is 37%, and the corporate rate is now a flat 21%. So a lot of people said, oh, I want to be the C Corp, which is the analysis that we talked about you might have. So what the Jobs Act did was they said, okay, if you have a flow-through entity, we're going to give you a 20% deduction for qualified trader business activity. So now if you think about it, if you're in the highest tax bracket, you're going from 37% to 29.6. So you can see you're coming down closer to where that corporate rate is. Now, there are certain industries that don't qualify, and they're considered specified service businesses. So those are pulled out. So you're not able to use some of those. And so, again, if you do have one of those specified service businesses, so you're not able to get the 20%, one of the things that they did, they talked about taxpayers that actually have adjusted gross income of $315,000 in 2018 and less. And in 2019, it actually went up to $321,400. So if your adjusted gross income, again, one of the things we talked about is how can we reduce adjusted gross income. If you're under that, then it doesn't matter what type of trader business it is, the 20% deduction does apply. But just remember, if you're at $300,000 or less, the 20% is 20% of a smaller tax bracket. So you're not in that 37 going down to 29.6. So something to think about. And then once you get over 415,000 in 18 or 400 in 2019, that's when it applies to only to qualified trader business income. And as you might recall, you are subject to the limitation of 50% of your W-2 wages or 25% of your W-2 wages and 2.5% of your adjusted basis of your investment assets. So that could be, fixed assets, capital assets. So that's one of the things that you could look at. And what I will say is I had an S corporation that I actually was working on this year for 2019, and we're doing some planning at the end of the year. And we realized that we're coming towards the end of the year and they wanted to pay a bonus. And I said, well, you know what, before we do the bonus, we should probably run some numbers, because if you pay the bonus, that's going to be taxed at ordinary income rates, might put you into the highest tax bracket. But you're also taking away from the fact that you'll be able to utilize the 199A deduction. And so it turned out that although there was some cost there to not do the bonus, by keeping it in the company and letting it flow through, we probably saved $10,000+ in tax. And so it worked out really well where we were able to look at it. And the other thing is we saved payroll taxes on that. Now, again, we have to make sure it's reasonable compensation, and their compensation was definitely reasonable. But we decided not to do the bonus because we felt that we got a bigger bang from this 20% deduction. And just as a reminder, this is only around till the end of 2025 and 2026. This is going to go away unless it gets extended. The next thing I want to talk about was the domestic production activity deduction. We're not going to go into a lot of it because it's no longer applicable even for C corporations. So the next is the business interest deduction under 163J. That's the disallowance of interest of 30% of your EBITDA. So for instance, if your EBITDA was $1 million, you take 30% of that, and to the extent that your interest was above that 30%, you would not be able to deduct it that year. Now, there is a small business exception, which is the $25 million, but I think what people are forgetting about is that small business exemption is really on a consolidated basis. So a lot of times people, just like when the Health Care Act came in and you were limited, if you had more than 50 employees, people were thinking, I'm just going to break up my companies. Well, the IRS realized that might happen, that people might try and break up the companies so that they could be underneath that $25 million gross receipts exemption. And they said you actually have to look at it as on a combined basis. So you actually have to look at all your entities to see if you're there. And one of the things that we did see this year was, I had a small real estate entity that had a mortgage on it, and the interest would have been limited if they were above $25 million. And we said, oh, great, we don't do it. But we looked at common ownership, and we realized that the common ownership actually had another facility that they did have $25 million or more gross receipts. So the interest then became limited at that part. So that was something that we had to talk about. But there are certain businesses, if you have real estate, that you can elect out of the interest limitation by electing real property trader business. And by doing that, it takes away the bonus depreciation, because it tells you have to use ADS depreciation. And so that's more of a straight line, and it takes it out further. So that is a disadvantage. But I think a lot of times you've got to play both scenarios to see which is better, to see if you should be making that election. Just to note that starting in 2022, the 30% limitation won't be on EBITDA, but it will be on EBIT. So that's something to make sure that you're thinking about. I mean, 2022 is going to be here before we know it. So it's some of the things that we may want to plan for, because maybe you want to pay down some debt earlier so you can get that interest deduction lower, so that it will be able to be deducted in 2022 and beyond. The next is meals and entertainment. That was another major overhaul. Entertainment is now 0% deductible. Meals are 50% deductible. Before, entertainment was typically 50%, and meals could be 100% if it was deemed de minimis, if it was for it was on the employee premises, if it was for the convenience of the employers and employees. But now it's all 50%, and starting in 2026, it's actually going to be not deductible. One of the things that is still deductible is if you're going to have a celebration employee benefit, where all the employees benefit, you could still take the deduction for that. And any food that's consumed in the lobby is still 100%, because it's for the mass public. I've been trying to tell them that we should put our kitchen and our lobby together into one room so that we could get the deduction for all that, but it was not the right answer. So something to think about, and that's a really big change. And in 2018, I definitely saw a lot of companies where this hit their bottom line because they weren't able to get that deduction. The next one that I think hit a lot of people by surprise was the employee parking. And I guess between the meals and entertainment and the employee parking, it kind of makes sense, because they gave us the great benefit for the 199A. They had to pay for it somehow, I guess. But the employee parking is no longer deductible. For instance, if it's included in your lease, you're actually supposed to break it out between what's the rental of the real property and what's the rental for the parking spaces. And the other thing is, we had a lot of companies that actually used to pay for parking for their employees. And by paying parking for them, it was great fringe benefit for them, but it wasn't deductible. And so a lot of people had to go back to the board, figure out if they could do some accountable plan there, or if they just let the employees pay for their parking, and maybe they gave them, a bonus to cover the employee parking. So they got a deduction for compensation, but the employees had the money to pay for the parking. Something to think about. And again, I think it was not a big topic last year, and it kind of hit a lot of people by surprise because it kind of got snuck in there at the end. The next major overhaul was net operating losses. For corporations, those losses are no longer carried back. And going forward, you can only use those losses against 80% of your taxable income. So if you had $1 million loss in 2018, but then in 2019 you had $100,000 of income, you'd say, well, I'm not going to pay any tax. I can wipe it all out. But you can't. You can only offset $80,000. So you'd still be paying on the $20,000 of taxable income. You can't zero it out. The carry forward is now unlimited. So you didn't have to worry about being limited to 20 years. So that is being carried forward forever. And but if you did have net operating losses that were pre-2018, they're not subject to the limitation. So those losses from 2017, 16, 15, if you have them, you can carry those and offset things as well. And the last thing I really want to talk about on the major overhauls, which again, people, kind of when you're doing the return, they kind of said, oh boy, now I kind of understand where this was going, is the non-corporate taxpayer business loss limitation. And what that meant was, as an individual, if I had business losses, typically I'd be able to use them against my non-business income. But the new rules said that if you do have business losses that are in excess of $500,000 for a joint filer or $250,000 for all others, you'll be limited to that $500,000. So if I made an investment, I made $1 million investment in 2019 that I ended up losing $1 million of business losses, and that was my only business, and I had a whole bunch of interest and dividends, even if I had $1 million of business of interest and dividends, I could not use those to offset each other. I'd still be limited to the $500,000. So I think there's some careful planning there, especially for people that have business losses. They should take a look to see what will be deductible and what will not as they're doing their estimated payments and year-end planning. So next we're going to talk about depreciation.
So depreciation has in recent years been very taxpayer favorable, and that continues. Our increased code section 179 expensing for tangible personal property and qualified real property is maxed at $1,020,000 for 2019, with a phase-out threshold increase to $2,550,000 in 2019. In addition, the definition of qualified real property, so qualified real property that now is allowed to take 179 expensing, has been expanded to include roofs, HVAC systems, security systems, and non-structural components. Those were not allowed to be depreciated in the past using the expensing election. Additional first-year bonus depreciation is 100% for qualified property through 2022. Starting in years 2023 and through 2026, that 100% is reduced by 20% per year. And then bonus depreciation sunsets after 2026. A new change in bonus depreciation, which was also very favorable, is that used property is now eligible for bonus depreciation. That was a huge point in the past. If a taxpayer acquired equipment or an asset that was used, they were not allowed to take bonus depreciation. So they were limited to the 179 expensing, assuming they were under the phase-out threshold. You can now, the property just has to be new to the taxpayer, not new property. Something to keep in mind when you're working on depreciation, you have to weigh the benefits and the pros and cons of expensing versus capitalizing, using 179 versus bonus, using makers versus 179 or bonus. I came across a very unusual situation this past tax season where taking makers actually saved the client over $45,000 as opposed to 179 expensing and or bonus. And that was due to some suspended losses that we were holding. We were able to offset the federal tax. And what we're going to talk about next is state add backs. So in this case, we were able to wipe out the federal tax through previously held suspended losses, and we were able to avoid the add back for state taxes. So on that note, most states have decoupled from the federal depreciation rules, the favorable rules. For 179 expense, you have to add back 80% of the 179 expense for states. That applies to Connecticut, but many other states have either that variation or some other variation of an add back. In Connecticut, for bonus depreciation, you add back 100%. So what happens then is in the next year, you can start taking a deduction for that depreciation, 25% per year for the next 4 years. That's how you get it back on Connecticut. But 2018 was the first year for the add back, so we saw some significant state level taxes and unintended consequences for the unexpected consequences for taxpayers. Another thing to consider when Andrew was talking about the 163J limitation, currently, at least when we're still weighing the EBITDA, if you're expensing assets, that is going to reduce your adjusted taxable income, and so it'll disallow more of your interest deduction as opposed to if you depreciate. That's a good strategy up until 2022, at which time depreciation is no longer an add back, and so it's not that big of a deal. It's important to note there was a drafting error in the tax code as it relates to real estate qualified improvement. So there were some changes to qualified improvement property where we consolidated certain categories and, tried to simplify, but someone forgot to say that this qualified improvement property is eligible for a 15-year life, thereby making it eligible for bonus depreciation. It's clear that that's what the intention was, to have it be 15-year life eligible for bonus, but it was missed in the actual drafting. So that property is subject to 39-year straight line. Treasury has stated that legislative action is required to make the correction. That has not yet happened, and that change has not been included in some of the year-end bills that are being put up for consideration.
Great. We're going to talk about some miscellaneous items, and I'll be brief on these because I just want to make people aware of them. There's the new qualified opportunity zones. That's where you're able to defer, or in some cases actually eliminate, the capital gains by taking capital gains that you've earned and rolling that capital gain into a qualified zone property. What I will say is there's been a lot of interest, but I haven't seen a lot of people go through with the plan. And I have seen some brokerage firms that are now starting to put these qualified opportunity zone packages together so that you could invest in that, and then they'll find the property. So very interesting. The research and development credit, again, because corporate has no AMT anymore, this is a home run because the R&D used to not be able to offset the AMT, so that's good. The credit cannot exceed the excess of the taxpayer's net income tax over 25% of the taxpayer's net regular tax liability over $25,000. So I guess, again, just a lot of things that just to make sure you're utilizing it. And the one other thing that is still out there is that if you're a startup company, within your first 5 years, if you're not sure you're going to be able to use that R&D credit, you can actually use it against your payroll taxes. There's a way to do that as well. So international taxation, just want to bring some things out to you. There's the GILTI, which is the Global Intangible Low Taxed Income. That's where U.S. shareholders of CFCs have to include in their gross income the income from that CFC. There's the BEAT, which is the Base Erosion Minimum Tax. That's for companies with $500 million and more in gross receipts. So I'll just mention that, but that's about it. And then there's the FDII, which is the Foreign Derived Intangible Income, and Code Section 250 allows a domestic corporation a deduction for the eligible percentage of the FDII or the GILTI. So what I would say is between transfer pricing, GILTI, BEAT, and the FDII, if you have some international operations, please talk to your tax advisor and figure out how these might affect you. Okay, great. We're going to talk about some state issues right now. So the first thing we wanted to do is just do a Wayfair refresher. As you might remember, the Supreme Court in 2018 in South Dakota determined that economic rule was constitutional if they had 100,000 of sales and 200 transactions. So essentially what they said is if you were selling into that state and you had over $100,000 of sales or 200 transactions, it gave you economic nexus, and so you would have to pay sales tax. Since the decision, pretty much every state has imposed a sales tax using these types of regulations except for Florida and Missouri. And so we'll talk about the states in our area just to kind of give you an idea. So Connecticut, reduced their threshold from $250,000 to $100,000, and it now includes services, and that's effective 7/1/2019. Massachusetts reduced theirs from $500,000 of gross receipts to $100,000 and removed transaction threshold effective 10/1/2019. And Rhode Island remains unchanged. They're at $100,000, but it now includes specified digital products. So our state tax group is actually reviewing what the definition of receipts is, but the general approach that we've been looking at is that economic nexus triggers a filing even if the sales are not taxable. So maybe you have 250 of sales into Connecticut that aren't taxable, but they're still looking for a tax return. So that's just updated economic nexus for the states in the Northeast around us. The other big thing that happened in in 2019 in Connecticut was the sales and use tax legislation. And so the first thing is digital downloads now have a state sales tax that went from 1% to 6.35%. So the biggest thing to think about here is Netflix, right? So now Netflix is going to cost a little bit more because the sales tax went up from 1% to 6.35%. There's also the prepared foods tax. So if you've gone in and bought some prepared foods from a grocery store, you might have noticed they're charging you 7.35% instead of 6.35%. The good news is originally they were looking at like bags of salad as being prepared foods. And at the last minute, someone said, no, we shouldn't be including those. So those aren't on there. It really is prepared foods that you can eat on the premises, at the grocery store. A lot of places, grocery stores now have the food courts. They're not talking about the foods that you're going to bring home. There's also the leaving the state tax, and for sales after 7/1/2020, a new 2.25 conveyance tax. It's called the mansion tax on real estate sold over $2.5 million. However, it only applies if the resident is moving out of state. For those staying, the tax still needs to be paid, but it can be refunded via credit. So if you're going to sell a big house and move out of the state, get ready to pay a little bit more conveyance tax. And then just real quickly, starting in 2020, there's going to be sales tax on dry cleaning and interior design services. So we've got, 15 days left. Get all your dry cleaning done and hire that interior designer to fix up that living room.
Okay, the last area we're going to talk about, Connecticut and Rhode Island PET. I touched on it a little bit when we talked about the state and local income tax deduction, just a little bit more in detail. Connecticut PET, somewhere around May 2018, we were told this was going to be instituted retroactive to 1/1/18. Because of the last minute notice, there were some automatic penalty waivers by Connecticut for 2018 returns if the tax was paid in a timely manner. New for 2019, again, we were notified in August of 2019 that this would be retroactive to January 1st, 2019. Guaranteed payments, which were previously excluded from the calculation of the PET, are now included in the standard and alternative base calculations. So this is going to create a significant tax in some situations where there are large guaranteed payments. The tax, if you're paying the tax based on prior year and you're safe harbored, then generally you wouldn't be subject to penalty, but do have to look out for a significant cash outflow when you file the tax return. Important to note, if you're a cash basis taxpayer, you're going to want to get that tax paid in by 12/31 so you can get the benefit of the deduction in 2019. Another change for 2019 is the credit that's applied at the individual level was formerly 93.01%. That was reduced to 87.5%. So you're going to want to make sure your estimated taxes are paid in to cover that potential shortfall in your individual return. Finally, election to remit composite tax in addition to the PET was implemented. This is basically for non-resident members or shareholders, and it's meant to cover the shortfall between the 87.5 and 100% of the business tax. If the tax is 100% paid into Connecticut, then the non-resident member or shareholder would not have to file a tax return. So that's the benefit. It would not be an expense. It would be treated as a distribution. And just be careful, if you're an S corporation, distributions are required to be pro rata. So you'd have to true up the other shareholders.
And just a quick note, I've actually seen that already with the guaranteed payments where, excuse me, the guaranteed payments were already paid, and then we said, well, we got to pay tax on it, and so that cash has already been out the door. So it's been, make sure that you're looking at it from a cash flow perspective, because technically the guaranteed payment would have had taxes taken out almost like a W-2, right? I mean, so it's one of those things you should take a look at.
And quickly, Rhode Island PET, this is new, effective in 1/1/19. This one is elective, not mandatory. The tax is on rental income, guaranteed payments, and other business income, and It's going to be implemented at the highest individual tax rate in Rhode Island of 5.99%. Good news is that the credit is 100% of the tax that is paid.
So I know we've kind of come up to our hour deadline. I guess what I'd say is if anyone has any questions and answers and we don't get to them, we will certainly make sure we respond. Okay, great. Just want to thank everyone for joining us today. We hope that you found it informative, and if there's anything we can do to help, please feel free to reach out to one of the professionals at Bloom Shapiro.
Thank you.